So once again, you are welcome to this training of today. I believe it will be as enlightening as the other ones, and we'll be able to impart some valuable knowledge. My name is Adekunle Cole. I'm privileged to be the managing consultant of KCP. The academic arm of KCP is responsible for this very training. I encourage each and everyone to listen as we go on, and where we ask questions, contribute meaningfully. And you can also ask your own questions too when it's time for you to ask the question. We set the ball rolling immediately. Today's topic is income tax, IAS 12, with special attention to deferred tax computations. We hope to lay a good foundation for this, while in our subsequent section, we'll be able to round it up. My point is we might not be able to cover everything today, but we'll try as much as possible to make today a meaningful event for each and every one. It is our custom to always put up this disclaimer. The essence of this talk shop or training, it's just for knowledge purpose. Should you want to apply whatsoever knowledge or insight you must have attained in the course of this session, we will advise that you reach out to us or reach out to any professional accounting firm that could be of service. We will not be responsible for wrongly applied knowledge that may be deduced from this session. As our custom is, we start with the teasers. We start with the teasers. Once again, I need to be very sure I'm not alone. I need each and everyone present on this platform to just eye me on the chat room. Just eye me on the chat room. Say hi if you can hear me. I need you to say hi on the chat room if you can hear me. Hello? Okay, awesome. Awesome. So we are good to go there. Blessing, you might probably need to check your network. I'm sure a couple of other people could hear me. Please check your network. I still need to respond from others. If you can hear me very well, just say hi on the chat room. Okay, good. Blessing, you please might need to check your network. It probably might be because of your network. All right, so the very first question we'll be having today is just to test our previous understanding or entry knowledge of this topic. Number one says, dash is the accounting standard on income tax. If you have the idea of this, just put it forward on the chat room. I'm expecting more response. Okay, IAS 12. Calculus says IAS 12. Okay, IAS 12. Awesome, awesome. Okay, let's quickly go to the next one then. Tax expense reported after profit before tax in the statement of comprehensive income comprise of dash and dash taxes. Oh, Blessing says current and deferred tax. We need response from others. Tax expense reported on the after the profits before tax in the statement of comprehensive income comprise dash and dash taxes. Okay, Evelyn says current and deferred tax. Okay, okay. Olawale says current and deferred tax. Okay, so let's look at the next one. The accounting entries to recognizing the tax effect of a deductible temporary difference in its first time of recognition is debit dash and debit and credit dash. When you are reporting deductible temporary difference for the very first time, how do you report these on the face of the financials and the income statement precisely and every other relevant financial statements? What do you debit? What do you credit? Any response from anyone? I'll take the question again. The accounting entries to recognizing the tax effect of a deductible temporary difference in its first time of recognition is debit dash and credit dash. Any response from anyone? Any response from anyone? Olawale says debit deferred tax assets and credit deferred tax credits. Oh, okay. Any other response from any other person? Debit tax expense and credit deferred liability. Okay, okay, okay. One more response before we go on. One more response. Any other person? The accounting entries to recognizing the tax effect of a deductible temporary difference. To get a good answer to this, you need to ask yourself, what is a deductible temporary difference? Okay, Evelyn says debit deferred tax and credit deferred tax credit. Oh, all right, no problem. I'm sure you will get clarifications on, to your opinion before the end of this session. Let's look at the fourth one. Okay, let's look at the fourth one. The fourth one says, dash is the amount of an asset or liability attributable to that asset or liability for tax purpose. Dash is the amount of an asset or liability attributable to that asset or liability for tax purpose. What do you think that is? Any response from anyone? Okay, Nelson says tax base. Okay, one more response, please. Any other person? Calculus says tax base. Okay. The next one says, dash is the difference between the carrying amount of an asset or liability in the statement of financial position and its tax base. Dash is the difference between the carrying amount of an asset or liability in a statement of financial position and its tax base. Who can provide answer to that? Oh, Adelaya says temporary difference. Ola Tokumbo, temporary difference. Okay, Olawale, temporary difference. That's good. A few more before we go on. Dash is the temporary difference that will result in taxable amounts in determining taxable profits or tax loss of future period when the carrying amount of an asset or liability is recovered or settled. Dash is a temporary difference that will result in taxable amounts in determining taxable profits or loss of future period when the carrying amount of an asset or liability is recovered or settled. Any response to that? Any response? Any response? Any response? Oh, it appears everyone is lost. Okay, we are almost there. The next one. Question 7. Dash is a temporary difference that will result in amount that will result in an amount that are deductible in determining taxable profit or loss of future period when the carrying amount of the assets or liabilities is recovered or settled. Deferred tax liability. Wahoo. Okay. All right. Festus says deferred tax liability. All right. Okay. The next one. Okay, somebody else says deferred tax assets. Oluchi says deferred tax assets. Okay, well noted. You get clarifications to these before the end of the class. Dash is the amount of income tax payable in future period in respect of taxable temporary difference. Question 8. Dash is the amount of income tax payable in future period in respect of taxable temporary difference. Nelson, that response is to which question? Is that question 8? Oh, okay. Noted. Then 2 more to go. Dash is the amount of income tax recoverable in future period in respect of deductible temporary difference, the carry forward of unused tax losses, and the carry forward of unused tax credits. Okay, Oluchi says deferred tax asset. Okay, one more response. Nelson is also of the opinion that it is deferred tax asset. Okay, one more. Any other one? Any other opinion? Okay, Abolani said deferred tax asset. Okay, good. The last one says deferred tax is the actual tax payable or recoverable from the tax authority True or false? Deferred tax is the actual tax payable or recoverable from the tax authority. Oh, false. Emmanuel says true. Okay. Nelson says not really. All right. Abolanle is of the opinion that is false. Okay, so we are good to go. I'm sure that our knowledge will be better enriched after we diligently listen to the content of this. We will try as much as possible to make it as simple and easy to be understood as possible. Here we go. The following are the course content. We'll have an overview of accounting standard on income tax. We will be able to look through what are the composition of the income tax contained in the financial statement. What are the related standards and interpretations on income tax provisioning and accounting? What are the key definitions of terminologies used in income tax provisioning and accounting? I will definitely look at estimation of current tax and deferred tax. Then what is the objective of IAS 12, which is a very relevant standard to this topic of discourse? What are the recognition criteria as proposed or contained in IAS 12 with respect to current and deferred tax? How does the standard propose that current and deferred tax should be measured? How does the standard presented or propose that current and deferred tax should be presented on the face of the financials? Then, of course, what are the disclosure requirements? And a couple of questions and answers. Now, in the overview, the first question I always want to ask on most of the standard is why tax expense provisioning? Why do we have to provide for tax expense? I recall that in some of our previous sessions that we've had, we were able to analyze that there are various status of businesses when you are registering with the CAC. Some businesses are registered or incorporated. For those ones that are registered, they are either an enterprise or a partnership business. And for the ones that are incorporated, they are either limited by shares, unlimited by shares, or even limited by guarantee. The tax obligations of each of these entities differs, and we'll be analyzing it as we go on. We'll also be looking at what are the types of tax. We've been able to establish that of the truth, there are tax to be paid by taxable persons. We'll be dissecting the various types of tax and how these types of tax relate to what we are looking at today. We shall also be looking at what are the components of income tax. When businesses makes income, which type of business are liable to paying income tax, and of which type are not liable to paying income tax. For those that are liable to paying income tax, what is the composition of this income tax? We'll be looking at that today. Then, of course, we'll be expounding on the relevant accounting standards that relate to income tax. and some of other interpretations. Then, for the standard that is relevant to our businesses and operations accounting responsibilities in Nigeria, what is the objective of that standard? Then, as contained in the standard, what are the recognition criteria? What are the measurement criteria of income tax? How should these be presented on the face of the financials? And what are the relevant disclosures expected to be made? But I need to state clearly here that when we talk about presentation as contained in any standard, we are simply referring to how will these accounting issues be replicated on the face of the financials, be it statement of financial position or statement of comprehensive income and other comprehensive income, the statement of changes in equity, or the statement of cash flows. And when we talk about disclosures, we are referring to how the relevant notes will be made with respect to the accounting issue under consideration. Then we'll have a few time for question and answer. Why tax expense provisioning? Why do companies have to pay tax? We've been able to establish from the beginning of this class that when every entity is registered with the CAC or incorporated with the CAC, sole proprietorship business or partnership business, we say the technical term is that they are registered. And how do we identify them? They often have BN numbers and certificates of registration. For the purpose of this discourse, business names, enterprise, partnership don't pay income tax. Why? It is as contained in the relevant law establishing them because they are not technically different from the owners. So anytime we talk about income tax, we are definitely not referring to registered businesses. Let's now look at the other incorporated entities. We've said it earlier that incorporated entities can either be limited by guarantee or limited by shares or unlimited. For entities that are limited by guarantee, incomes or profits made within their operational clause is usually not taxable. However, where this particular profit is now redistributed to the promoters of the company, it then becomes taxable. So if that is the case, when the financials of such companies are being prepared, there would then be reason or need to accrue for tax expense. Then, of course, the last two types, limited and unlimited. These two categories of entity are definitely presumed to have commenced business for profit motive. Therefore, any period when profit is made, not income, when profit is made, there will definitely be what? Tax payable. So for the purpose of this discourse, we are definitely looking at entities that fall into that bucket, whether limited by shares or unlimited. And with that, we've been able to do justice to what I put in my diagram as company. Where the company makes profits, they are expected to give back to the society as a sponsor to every government responsibility. Their contribution to the government, to the society, is what we call tax. Therefore, Tax is not an optional payment. It is not a contribution. It is a compulsory payment. Taxes generally can be classified into two. Some are direct tax, some are indirect tax. What are direct tax? A simple and layman's meaning of this is any form of tax whose tax burden, the burden of payment, the inconvenience of having paid this tax, is felt directly, is borne directly by the payer. A typical example of that is what we call the company income tax. Other forms of this is what we call the education tax. You can also have it as capital gain tax. Sometimes for some categories of companies that are liable to that, you can also have what we call petroleum profit tax. So in a nutshell, a typical example of direct tax are CIT, EDT, CGT, and PPT. I take that again. Company income tax is the CIT. Education tax, which we call tax fund now, is the EDT. CGT is the capital gain tax, and PPT is petroleum profit tax. These taxes, the burden of payment is directly felt by the taxpayers. Hence, we call them direct tax. The other is what we call the indirect tax. We're trying to drive home at something, trying to lay a good foundation for our proper understanding of what is contained and the intention of IAS 12. So in the indirect tax, you have this form of taxes, the burden can be transferred to another party who is not the primary payer, right? A typical example of that is the value added tax, VAT. The people that actually bears the burden of this payment is the final beneficiary of the services or the final consumer of the goods. So this sometimes we call it the transaction taxes, right? So a typical example, as I've mentioned earlier, is the VAT. Other examples of that is the excise duty, the customs duty, name them, right? So I believe you are following. Please, if you are with me and you can hear me very well, I need you to confirm on the chat room by saying hi. Awesome. Awesome. Good. Good. So we are good to go. Okay. We are fine. We are fine. So the next thing we'll be looking at is the accounting standard on income tax. The accounting standard on income tax. I remember for those who were privileged to attend our last session on accounting for leases and tax implication of leases, we were able to establish in that class that prior to 2012, we used to have a standard setting body in Nigeria, which we call NABS, Nigerian Accounting Standard Board. But with effect from 2012, we have a new standard setting body, which we call the FRCN, Financial Reporting Council of Nigeria. The standards, the accounting standards that were issued by NABS prior 2012 were called SAS, Statement of Accounting Standards, while those that are issued by the FRCN, sometimes or most of the time adopted from the International Accounting Standard Board, are either called IAS, International Accounting Standards, or they are called IFRS, International Financial Reporting Standards. Now, as far as the SAS is concerned, We used to have a standard which we call SAS 12, and the standard was on income tax. We'll be briefly looking at what are the contents of the SAS 12. Were there any material difference between the accounting treatment as contained in SAS 12 with those of IAS 12? Materially, there are no difference except the recent amendment made to IAS 12. Then briefly, we'll also be looking at what we call IFRIC. Let me put a question to the house. IFRIC, I've been able to tell you what SAS means. I've been able to mention what IAS means and also IFRS. What is the full meaning of IFRIC? Who has a response to that to put it on the chat room? IFRIC. 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 Anyone? IFRIC. Anyone? Okay, awesome. I had Blessing says International Financial Reporting Band care. No. Interpretation Committee. Okay. So that's IFRIC, International Financial Reporting Committee. All right, so good. We are good to go. So there were some interpretations. Most of the time when there were ambiguity as contained in the standard, when there is any misinterpretations of the accounting standard, IFRIC will always issue interpretations. So there were some interpretations of the misconceptions as contained in IAS 12. We'll be looking at these in details in some of our subsequent class. So we have IFRIC 23, which talks about uncertainty over income tax treatment. We'll be talking about that much later on. Then IFRIC 7, that talks about applying the restatement approach under IAS 29, financial reporting in hyperinflationary economy. Then SIC 21 talks about income tax recovery of revalued non-current assets. Then SIC 25 that talks about income tax changes in the tax status of an enterprise or its shareholders. So some of these interpretations are the most complex, contains the most complex aspect of IAS 12. But as we go on, we try as much as possible to do more justice to this. So thus far, we've been able to establish that we used to have a standard called SAS, which is on income tax. But because Nigeria has joined most of the part of the world that have adopted IFRS as a financial reporting standard, most of our discourse today will be centered around what were the content and the propositions or the suggestions or recommendation as contained in IAS 12. But before we dig more down, what are the key terms that are used in income tax as contained in IAS 12? Number one, we talked about what is tax base. You need to have a good understanding of these terminologies. Otherwise, there might be some problem understanding what's the whole essence and idea that is behind deferred tax. Whenever we say tax base, what are we referring to? The tax base of an asset or liability is the amount attributed to that asset or liability for tax purpose. The simplest meaning of this is that when we prepare financial reports as an accountant, we use certain terminologies, such as we say some things are PPE, some things are current asset, some things are current liability, some things are carrying values and the likes. So also within the tax space, when a tax administrator or consultant also is doing their tax computations, there are some terms they use. So, and one of those terms is what we call the tax base. So I'll take that again, that the tax base of an asset or liability is the amount attributed to that asset or liability for tax purpose. What we are trying to say in essence is this: if I want to use to tax an asset, right, the amount I attribute or relate or call that asset is called the tax base. And if I want to tax a liability, the amount attributed to that liability as a metric to calculating or estimating my tax liability is called the tax base. So you will often see this term mentioned here and there as we go on. Another technical term we need to understand within the purview of IAS 12 is what we call temporary difference. Temporary difference. What is the meaning of temporary difference? I've told you that we have two distinct disciplines, even though in Nigeria we don't see them as two distinct. Financial reporting is a distinct discipline. Tax consulting or practice is a distinct discipline. The way a taxman thinks is not the same way an accountant thinks, right? Accountants that prepares financial statements or financial reports are rigidly guided by what we have as contained in the regulatory framework and our accounting standards. But when a taxman thinks or prepares any report, he strictly obeys what the tax laws are said. Why the law to an accountant are what we call the regulatory frameworks and the accounting standard. The law, which is of more concern to a taxman, is our tax law. And when I say our tax law, depending on the type of tax we are looking at, we inform the law we'll be making reference to. CIT is governed by the Company Income Tax Act. PIT is governed, or PAYE is governed by the Personal Income Tax Act. PPT is governed by the Petroleum Profit Tax Act. VAT is governed by the Value Added Tax Act. CGT is governed by the Capital Gain Tax Act. Are we together? So, as far as this is concerned, there are some times that when we make comparison between certain variables, there might be different. We'll be comparing what estimates an accountant has given and what estimates the taxman has given. When there is difference between these estimates of the same nature, but giving different names, we say that is what we call temporary difference. Let's now relate this explanation to the context of our discourse. Temporary difference is taken as the difference between the carrying amount. You will know that within the accounting practice, the value that is used or is recognized, with which an asset is recognized or a liability is recognized, is called a carrying value, right? So the difference between the carrying value of an asset or liability, as far as the accountant is concerned, in the statement of financial position compared with the value that a taxman will call it, which we call the tax base. The difference between them is said to be temporary difference. Let's pick a typical example of this. When you pick an item of PPE in the financial statement, a PPE bought in the first year, An accountant will call the cost, the amount of acquiring it, the cost, right? When this particular PPE is subject to depreciation, provided it is being used in the business, right? When you deduct the depreciation from this cost, year in, year out, accountants will call this value no longer the cost, but the carrying value, right? When a tax person wants to look at this, we call it the tax base. In tax, we don't recognize depreciation, even though we recognize cost of an asset, but we don't call it cost of an asset. We call it qualifying capital expenditure. Now, in lieu of the depreciation, the tax law allows us that we should give capital allowance. When you deduct your capital allowance from the qualifying capital expenditure, the cost of that, what we have is the tax written down value. While the tax written down value is to a tax consultant, carrying value is to an accountant. When you now look at the cost of this in any year under consideration, if the carrying value of an amount is 40 million, and in tax estimate, that same asset is being valued at 30 million. There is a difference between 40 million and 30 million. That difference is what we call the temporary difference. I believe I've been able to explain this very well. If you understand me, just say I on the chat room. Awesome. I need more response. If you understand what I've explained about tax base and temporary difference, say I. Okay, good. So we are good to go. So let's look at the next one. This temporary difference, depending on the nature of it that will be expanding much more, can result into a taxable temporary difference, and sometimes it can result into a deductible temporary difference, right? I'm going to take that again. Temporary difference, which you say is the difference in the valuation by an accountant or a tax consultant, can result into a taxable temporary difference or a deductible temporary difference. Let's start with taxable temporary difference. A taxable temporary difference is a temporary difference that will result in taxable amount in determining the taxable profits or loss of future period when the carrying amount of an asset or liability is recovered or settled. These are just vocabulary or terminologies of the standard. Let's bring it home. Whenever we say taxable temporary difference, we are indirectly saying that there are some differences we will have that will result us in paying more tax in future, right? I'll take that again. There are some differences we will have that will result us in paying more tax in future. That is called taxable temporary difference. Most of the time, this will result into what we call deferred tax liability. But I'll talk much more about that in future. In subsequently as we go on. So anytime you have taxable temporary difference, what should come to your mind is what? This is not definitely deferred tax liability, but of course, it will result into what? Deferred tax liability. Then we have what we call the deductible temporary difference. Let's look at the jargons of the standard. The standard put it as, this is a temporary difference that will result in amounts that are deductible in determining taxable profits or taxable loss of future period when the carrying amount of an asset or liability is recovered or settled, right? What this then means is that you have a taxable difference that will make you pay less tax in future. That is why we call it deductible. It helps in reducing your possible tax exposure in future. While taxable temporary difference results in you paying more tax in future, hence we say it will result into deferred tax liability. On the contrary, deductible temporary difference will often result into what we call deferred tax assets. I hope that is understood. I need a confirmation by saying yes, yes, yes on the chat room. If you understand, say yes. Good, good. Okay, so we are good to go. We are good to go. So the next one is deferred tax liability. I've said that deferred tax liability will often crystallize from taxable temporary difference, right? In the wordings of the standard, we put it as the amount of income tax payable in future period in respect of taxable temporary difference. The amount of income tax payable in future period in respect of taxable temporary difference. Is that clear? Then, while the deferred tax asset, we said this will often arise from deductible temporary difference. So in the wordings of the standard, it is put as the amount of income taxes recoverable in future period in respect of deductible temporary difference or in respect of the carrying forward of an unused tax losses or in respect of the carrying forward of an unused tax credit. So most of the time, deductible temporary difference is usually arise from whether a taxable person has some unused tax loss. You know that when a company has unutilized tax loss, it can be used in offsetting its future tax profits. So that is why we say that whenever a company has deferred tax liability, it may be as a result of unutilized losses, unutilized tax credits, particularly capital allowance, or the amount of income tax recoverable in future in respect of any other thing that could give rise to deductible temporary difference. Then when we say the last one is deferred tax or deferred liability. Deferred tax or deferred liability. 1 minute, please. Just want to make an adjustment somewhere. Please, can you see my screen? Confirm, please, if you can see my screen. Just say aye if you can see my screen. Good, good, good. So the next one is deferred tax or deferred liability. Now, we've been able to explain that taxable temporary difference may give rise to deferred tax liability. Deductible temporary difference may give rise to deferred tax assets. How then can we ascertain what a deferred tax asset is, or a deferred tax liability is? If you have the deductible temporary difference that will result to deferred tax assets, and you multiply this by the prevailing tax rates, what you have is then the deferred tax assets. That is why I said that deferred tax asset or liability is is determined by multiplying the temporary difference by the tax rate. Multiplying the temporary difference by the tax rate. Why I'm taking my time to explain this much is because we have different people with different background on this particular session, and we should try as much as possible to carry everybody along. Okay, so having cleared most of the common terminologies that are related to IAS 12, we can now go into discussing about IAS 12. If we are on the same page, if you understand what I've said thus far, say yeah, yeah, yeah on the group. Good, good, good. So we are good to go. We are good to go. So the next thing is now, what is really the objective of IAS 12? We've been able to establish that the standard that emphasize or recommend that we must provide for income tax is IAS 12. And what are the categories of businesses that should make this kind of provision? It is not an enterprise. It is not any registered business name. It is not any company that has a business number. So that is why I'm emphasizing this is that some of us are accountants working in a registered business name, whether a sole proprietorship or a partnership. When you are preparing your financials, the standard did not say you have to make provision for income tax. Why? Within our tax law, the law does not recognize enterprise to paying income tax. That is why deferred tax provision or company income tax provision should not be made in the book of any sole proprietorship or partnership. The business on its own does not pay tax, but the owners of the business pays tax. Is that clear? So I believe you understand that. But for any other company, you identify an incorporated company by companies that on their CAC document, you will see RC number, but other ones are BN numbers. I believe I've been able to make that disparity. So what then, this standard is actually applicable to those entities that has RC numbers. They are the ones that are incorporated, that are liable to paying income tax. And in determining this income tax, a taxman or a tax consultant will adhere strictly to what we have in the Company Income Tax Act. If that company is into a petroleum business, then the tax consultant will adhere strictly to what we contain in the Petroleum Profit Tax Act. But an accountant will always want to make its provision based on what the standard had said. So let's now see what is the objective of the standard. The objective of the standard IAS 12, when it was issued in 1996, is to prescribe the accounting treatment for income tax, how to recognize income tax, what are the things you have to do when you are making provision for income tax. All these are contained in IAS 12. In meeting this objective, IAS 12 notes the following, that one, it is inherent in the recognition of assets and liabilities that assets or liabilities will be recovered or settled, and this recovery or settlement may give rise to future tax consequence, which should be recognized at the same time as the asset or liability. What does those professional jargons mean? What they are trying to say is that for every incorporated entities that goes into business, when you render your service or when you sell your goods, you earn income and you incur some expenses. For the purpose of earning that income or running that business, sometimes you acquire some assets and sometimes you acquire some liability, you incur some liability. In the course of doing this, it is expected that before your tax is determined, recovery or concession will have to be given on the amount you have expended in generating that income, as well as the costs that you have incurred on those assets, as well as the liabilities. So in the course of trying to claim this recovery, there are some tax consequences that will give rise on the shortfall between your income, your expenses, and all the recovery of the assets and liabilities. So that is number one. So the IAS 12 is trying to tell you that you need to know that there are inherent in the recognition of these assets and liability, there are tax consequences, right? And those tax consequences could arise in future. You need to make provision for that. That's one. Two, that an entity should account for the tax consequence of the transactions and other events in the same way it accounts for the transactions or other events themselves. What do we mean by this? When you recognize income and when you recognize expenses and when you recognize your assets, liabilities, and equities, the standard is telling you, arising or consequent to all of these recognitions, there are tax obligations every incorporated entity has. So on a regular basis or an annual basis, while you are making the preparation of your financials, these tax consequence has to be what? Provided for. And what is the component of this tax consequence? We'll talk about it as we go on. Okay, so this tax consequence is what I put as component of tax expense, right? Component of tax expense. As far as the standard is concerned, IAS 12, which is not different from what was contained in SAS 12, it recognizes that this tax expense can also be called income tax. I've said it times without number, that BN registered company, like the sole proprietorship, the partnership, don't pay income tax. So they are not the kind of company we are looking at here. If you are preparing financials for such company, you are not expected to make provision for income tax. You are not expected to make provision for income tax. But if we are looking at incorporated entity, which is our subject of concern here, we must prepare and make provision for those income tax. And it will come at what level? When you have prepared your income statement and you get to profit before tax, the next thing is the tax expense or income tax, and you have profit after tax. What we are looking at today is how do you determine that income tax or tax expense? The standard has emphasized that this tax expense is classified into two. You have the first on my left, which I call the current tax, and you have the one on my right, which I call the deferred tax. So anytime you see any amount provided as tax expense or income tax, it is expected that it should contain these two, the current tax provisions and deferred tax provisions. I take that again, the current tax provisions and deferred tax provisions. The current tax provisions, how do we ascertain this? This is exactly what we do when we adhere to all the tax laws with respect to the tax treatment to every component of the financial statement. Some of those incomes that we have earned in a particular period, the tax law may say that some of them are not taxable, some of them are taxable. So when you are providing for the current tax, the ones that are not taxable, you need to derecognize them, while the ones that are taxable, we recognize them in ascertaining what the tax provisions will be. Then some of the expenses that we incur in generating the income, as contained in the tax law, some of them are allowable expenses, meaning that the tax law recognizes them that they are genuine business expenses, while some of them are not recognized by the tax law, so we disallow them. That means that the accountant will have deducted them, but what we need to do to ascertain our tax provisions is we add them back, because the tax law does not reckon with these with these expenses. So under the current tax expense, we have two different classifications or category there. You remember that in line with IAS 1, presentation of financial statement, the statement of income has two segments. You have the comprehensive income and you have the what? Other comprehensive income. The tax consequence, the current tax consequence of transactions or postings into the comprehensive incomes will be recognized. And the tax consequence of the transactions that appear in the OCI, other comprehensive income, will also be recognized. Most of the time, the postings we make to the comprehensive income will most of the time give rise to company income tax if the company has been able to make a taxable profit, and the education tax if the company has been able to ascertain an assessable profit. We'll talk about that much more later. So you need to know that your current tax provision can be in the comprehensive income statement, can also be in the OCI statement. But in the comprehensive segment, you will most likely have CIT and EDT. So when we say we are doing adjusted profit computation and company income tax computation, what we are trying to do is to ascertain the CIT component of that is attributable to the comprehensive income and the EDT that is attributable to the comprehensive income. But depending on the nature of items you have in the OCI may lead to what we call this type of tax, capital gain tax, or sometimes on very rare locations, you have it resulting into CIT. So, but when you do all of this, what you are simply doing is the current tax provisions. In one of my earlier questions, I said that there are two components of tax that should be contained in the tax expense is the current tax and deferred tax. The type of tax that a company actually pays to the relevant tax authority is the current tax. But the deferred tax provisions is not payable to anybody. We are only adhering to this or making this provision in line with the matching concept that says that every expenses and income, whether due for tax now or later on in future, but that relates to a particular period, must be matched together. The matching concept emphasizes that. So at no time do we or should we pay what we have estimated as deferred tax to the tax authority. It is just helping us to match every provisions or transactions now that we have taken, that has taken place now, but that could give rise to future tax. We are making provision for all those tax implications here and in the current period. So note, it is only the current tax that is payable to the government, while the deferred tax, we are doing it because the standard says that we should match every expense and income that relate to a particular period in ascertaining the profit or loss for that period. So back to the other side of the tax expense, the deferred tax. That could also, there could be on the comprehensive income side of the income statement, we could have transactions that will result to deferred tax, while on the OCI part, we could also have some transactions that will lead to temporary difference and as a result, resulting into deferred tax liability or deferred tax assets. So the deferred tax liability you will see under comprehensive income, the deferred tax that you will see under the comprehensive income can be a deferred tax asset or it can be a deferred tax liability. Same thing with the OCI, the deferred tax asset or deferred tax liability. But I need to clear this. How do we differentiate a deferred tax asset from a deferred tax liability? A deferred tax asset, when we are computing it, will usually appear as a negative. It will usually appear as a negative, right? It will usually appear as a negative. while a deferred tax liability will usually appear as a positive. It will usually appear as a positive. I emphasize, deferred tax asset will usually appear as a negative, meaning that you are having a recovery, That is why we say it is as a result of the tax consequence on a deductible temporary difference. But deferred tax liability will usually appear as a positive, which we say it is the tax consequence on taxable temporary difference. I need to be sure that everybody is with me. So if you are following me and you've understood what I've explained thus far, just on the chat room say aye. Okay. Okay. Awesome. So we are good to go. So I've also emphasized that in computing our company income tax, there is a current tax provision we adhere to the Company Income Tax Act, and the relevant sections of this is as contained in section 40 that prescribe the tax rates, the company income tax rate, and section 33 that talks about the minimum tax, where a company has been in existence for more than 4 years but does not have a taxable profit. The law expects that you have to pay a minimum tax. Then section 30, where a company, in the opinion of the tax authority, if they are not satisfied with the tax provisions that you have ascertained by section 40 and section 33, they can also subject the company to tax under turnover basis. That is as contained in section 30. Then on some other cases, they may also subject a company to tax under section 19, dividend basis. That occurs when the tax you have paid in a particular period could have been higher if that tax rate is applied on the dividend that the company declared in a particular period. So that is as contained in section 19. I keep on emphasizing this because this represents the actual tax that you will pay, which we call the current tax. But the deferred tax is just a provisioning that we are doing because the accounting standard says that every expenses or income that relates to a particular period must be adequately matched together in ascertaining what the profit or loss may be. All right. So we've been able to clarify thus far what are the components of tax expense, what are the components of current tax expense, what are the components of the deferred tax, right? Then I also need to clear it here, though I've explained that before, the deferred tax element. Whenever the cheapest way to identify this, to identify a deductible temporary difference that gives rise to a deferred tax asset, is the tax base of an asset or the tax base of an asset when it is higher than the carrying value of an asset, then it gives rise to deductible temporary difference, right? When the tax base of an asset is higher than the carrying value of that asset, it gives rise to deferred tax asset arising from the deductible temporary difference. Then the opposite of that will give rise to deferred tax liability. So what are the recognition criteria for deferred tax, recognizing deferred tax as contained in IAS 12? Recognition of deferred tax provides that a deferred tax asset is recognized for deductible temporary difference, unused tax loss, or unused tax credit to the extent that it is probable that taxable profits will be available against which the deductible temporary difference can be utilized unless the deferred tax asset arises from 1, initial recognition of an asset or liability under the business combination, which at the time of the transaction does not affect accounting profit or taxable profit. What does this terminology or topology as contained in the standard means? The standard is just trying to tell you that you should recognize a deferred tax asset when you have a deductible temporary difference, which is taxable, right? And arising from the tax consequence of it, what it is just telling you is that deferred tax asset appears like an income to the taxpayer. It is a notional income because it is not the actual amount you pay, right? So they are now telling you that if it is like an income, a tax income, you can use it to offset part of your future tax provisions, right? But before you will recognize this tax income or tax assets, you must be sure that that company you are looking at or you are preparing its financials is in a position to earn or to having a taxable income in future. If it is not visible that that company will have a taxable profit in future, you need to stop recognizing deferred tax assets. You need to stop recognizing deferred tax assets. I repeat, deferred tax asset appears as an income, right? And it should only be recognized when the company has a higher probability that there will be a future taxable profit. Where you are auditing a company or you are preparing the financial statement of your company, and year in, year out, what the company recognizes is loss, 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 loss. And after you've done the tax computation, you are having tax loss, tax loss, tax loss, tax loss. You know you will have been accumulating deferred tax asset. If it is not visible that that company will likely have taxable profit in future, the standard says stop accumulating deferred tax asset because it is not very probable that you'll be able to utilize it in future. So other things that could give rise to deferred tax recognition is the carrying amount of the deferred tax asset are reviewed at the end of each reporting period and reduced to the extent that it is no longer probable that sufficient taxable profit will be available to allow the benefit of part or all of the deferred tax assets to be utilized. That is to further buttress what I've explained earlier. Any such reduction is subsequently reversed to the extent that it becomes probable that sufficient taxable profit will be available. Please, these are very sensitive areas of the standard that you will only understand the computational aspect very well if you have a good rudimentary knowledge of what I've explained thus far. So I need to be sure that everybody is with me and understand me. Can you type I on the chat room if you understand what I've explained thus far about recognition of deferred tax assets? I need a confirmation of I on the chat room if you actually understood what we have said thus far. Okay, so we are good to go. Now, recognition of the income tax that we have talked about, this is just to further buttress what we have explained thus far. The amount of income tax to be recognized in a period includes the current tax for that period and the movement in deferred tax period. I will show you a template of a deferred tax computation, and I will let you know what I meant by movement in the deferred tax for the period as we go on. Now, please let me just show you something. Hold on. It's taking time before it comes up. Maybe I will show you as we go on. Let's just go on to avoid wasting of time. Okay, let me know if you can see my screen. Hello? Confirm on the chat room if you can see my screen. Okay, good. Okay, so I'll show you that. I'm trying to show you something, but it's taking a while before it come up. So let's just continue maybe before the end of the class or in our subsequent class, we will do the practical aspect of this and we'll be able to see the practical approach of how to compute deferred tax provisioning, whether resulting to a liability or an asset. Okay, so where to recognize income tax for the period. Now, the wording of the standard, consistent with the principle underlying IAS 12, the tax consequence of transactions and other events are recognized in the same way as the item giving rise to that tax consequence. Accordingly, current and deferred tax is recognized as income or expense and include in profit or loss for the period, except to the extent that the tax arises from them. Now, when do you have a deferred tax to be an income? And when do you have a deferred tax to be an expense? You have a deferred tax to be an income when you have a deferred tax assets. And you have a deferred tax to be an expense when you have a deferred tax liability. If you are recognizing this for the very first time, I asked this question at the beginning of our session, that when you have a deductible temporary difference that gives rise to a deferred tax asset, how do you recognize it? I think most people did not get the question right. So what you do is, if I have a deferred tax asset, how do I recognize it? The accounting entries is to debit a deferred tax asset which is part of my non-current asset. And the corresponding entry will go to my tax expense in my income statement, whether in this comprehensive income or the OCI, depending on the source of the event that gives rise to that very asset. I'm taking that again. Whenever you are recognizing a deferred tax asset for the very first time, you are to debit a deferred tax asset and credit the income, the tax expense on the income statement. By so doing, rather than your tax expense appearing as a jacket, it will appear as a positive figure. That is why we say deferred tax asset appears as an income on the statement of comprehensive income. But on the other way around, the deferred tax liability appears as an expense on the statement of comprehensive income. And how do we post this? Because it is a liability, we will recognize this as a non-current liability in the statement of financial position. That is a credit to the liability account. The liability account is called the deferred tax liability, while the corresponding debit entry will appear on the tax expense as a debit. Because it is appearing as a debit and we often deduct expense, it will appear in a jacket, right? Deferred tax assets appears as a positive figure, hence we call it an income. Deferred tax liability appears as a negative figure, hence it will be deducted alongside with the current tax expense from the profits before tax. So I want to assume or believe that everybody understood that. Please, if you understand what I have explained thus far, just confirm on the chat room by saying hello, hello, hello. Okay, good, 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 good. So we are on the same page. We are on the same page. So still under where to recognize income tax for the period. Transactions or events that are recognized outside the profit or loss or other comprehensive income or equity, in which case the related tax amount is also recognized outside the profit or loss. Remember that I said earlier on that our income statement appears in two segments, the comprehensive income and other comprehensive income. If the event that give rise to the deferred tax assets or liabilities originated from the comprehensive income, the deferred tax that accrues will be recognized immediately after profit before tax, right? But if the event that gave rise to that deferred tax asset or liability actually originated from the other comprehensive income, then that deferred tax component will be recognized in the OCI segment. That is what we are trying to say here. And if the event that gave rise to that deferred tax asset or liability is actually an equity, a component of the SOCI, right? Then that deferred tax element will also be recognized under the equity segment, that is under the SOCI, statement of comprehensive income. Statement of changes in equity, I meant to say. Then the next one is a business combination, in which case the tax amounts are recognized as identifiable assets or liabilities at the acquisition date and accordingly effectively taken into account in the determination of goodwill when applying IFRS 3, business combination. So what we meant by this is that in the wordings of the standard, whenever you actually recognize intangible assets of this nature arising from IFRS 3, at the very first time of initial recognition, deferred tax component should not be recognized because that particular component, according to the standard, is expected to be suspended. But when that deferred tax is, when that goodwill is now being carried forward and subjected to impairment test, it will then give rise to deferred tax issue. Then we've completed the the recognition criteria. You now know what could happen before we recognize, or what should have happened before we should recognize deferred tax, whether as a liability or as an asset. How then should we measure deferred tax? Deferred tax measurements, whether a deferred tax asset or deferred tax liability, are measured at the tax rate that are expected to apply to the period when the asset is realized or the liability is settled, based on the tax rates or laws that have been enacted or substantively enacted by the end of the reporting period. Please listen to it. This is a very, very critical aspect of the standard. I'm sure everybody understands that with effect from 2019, there have been a concurrent changes to our tax law through the Finance Act. When the Finance Act of 2019 was introduced, there were some critical changes that were made to our tax law. Before the advent of the 2019, companies that are incorporated are expected to pay taxes. Very few companies, maybe those who are operating with turnover of less than 2 million, are actually exempted, right? But most companies that are incorporated actually earn more than 2 million in a year, and they are actually taxable, right? Whether they make, even if they don't make a taxable profit, provided they are within the first 3 years that they are not exposed, first 4 years that they are not exposed to minimum tax. Otherwise, materially, every company are exposed to taxes. And the prevailing tax rate then across board for most of the companies was 30%. 30% for CIT, 2% for education tax. But the advent of the Finance Act has introduced different rates to companies, right? The Finance Act now recognizes companies in 3 different categories. The first category are said to be the small company. The second category are said to be the medium-sized company. The third category are said to be the large company. Who are the small company? Companies that are doing turnover of less than 25 million. They are small company. And their tax rate is stated as 0%. Not that they should not pay tax, but they should pay tax at 0%. And if you apply 0% on any amount, it still gives you nil, right? Then the second company are the medium-sized categories of company. These companies are expected to do turnover of from 25 million up to, but less than 100 million. Less than 100 million. The tax rate also, the section 40 was also amended to recognizing their tax rate to be what? 20%. 20%. Please, I need you to pay attention to this because this particular Finance Act amendment actually changes the mode of our deferred tax provisioning. Then the last categories of companies are regarded as large companies. These are companies that are doing turnover of above 100 million and above. And the tax rate of these companies is expected to be at 30%. Now, there was a debate as of 2019, which was subsequently amended, that because small companies are paying tax at 0%, invariably, some school of thought says they will pay education tax. Some school of thought says they will not pay education tax. But eventually, it was clarified that they are not also liable to education tax. Invariably, they are not liable to education tax. But those who are medium-sized company and large company are still liable to education tax. What impact does this has on our measurement of deferred tax? Before 2019, when the amendment was made, every company that is liable to tax makes their tax provisioning for deferred tax purpose at 30%. The impact of this is that for a small company that have been carrying forward a deferred tax asset or carrying forward a deferred tax liability up till 2019, as far as that company is still within the purview of the law, a small company, from 2019 account to date until when they exceed that boundary of 0 to 25 million, they will stop to recognizing deferred tax, whether an asset or a liability. The reason is this. Let's look at this statement again. Deferred tax asset or liability are measured at the tax rate. With this, my explanation, the tax rate of a small company within our Finance Act is now 0%. Invariably, the standard or the Act is telling you that even though you might have deductible temporary difference resulting from the transactions of a small company or taxable temporary difference resulting from the transaction of a small company, deferred tax cannot be booked because the tax rate is 0. Then the next one is deferred tax or provisioning for a medium-sized company will no longer be, it has always been 30% before 2019 Finance Act. But with effect from the Finance Act of 2019, it will no longer be 30% because the tax rate is now 20%. So for CIT purpose, any deferred tax temporary difference giving rise to CIT tax exposure will now be booked at 20%, no longer 30%. Why? Because our tax rate has been changed. This will also change if tomorrow the Finance Act, another Finance Act is being issued and reverse or further reduce the tax rate. While the deferred tax provision, whether for assets or liabilities of a large company, will be booked at 30%. Why? Because the tax rate actually specifies that it is what? It is at 30%, right? But deferred tax provisioning doesn't have to affect CIT alone. There are some temporary difference you might have that may not give rise to CIT tax exposure, but a PPT tax exposure, petroleum profit tax. So the deferred tax provision will be made using the effective PPT tax rates, right? When such temporary difference will give rise to a CGT tax exposure, you also have to use the applicable tax rate for the CGT. I hope this is understood. I need to be sure that everybody understands this clearly. If you understand it, please say yes on the chat room. Say yes on the chat room. If you understand this, say yes on the chat room. Okay, good. I need more response. I need more response. Oh, Olawale says I should repeat the explanation on CGT. Okay, I will explain that with this illustration. I will explain that with this illustration. When we all know that CGT arises when there is a disposal of a chargeable assets, right? And the CGT, the capital gain, resulting into a capital gain, I mean to say, when there is a disposal of a chargeable asset resulting into a capital gain. Now, how do we ascertain the capital gain? It is the difference between the disposal proceeds minus the cost of the assets, right? Let's now assume that there is a discontinuance of a business line of operation. You know that when such transaction occur, it will not be recognized in the comprehensive income. It will definitely be recognized in the what? Other comprehensive income. Now, the applicable tax rates when you dispose such thing is not a CIT tax exposure because we are disposing an asset. It will only give rise to a CGT. I will use another typical example. We may often have what we call IAS 40, investment property, IAS 40. When we dispose an investment property, the applicable tax on that disposal is not CIT, it's not company income tax, because the gain we make is not a profit, rather it's a capital gain or a capital loss as the case may be. So the applicable tax that we arise will be capital gain. Now, there is a caveat in the Capital Gain Tax Act. When you dispose an asset, a capital gain, and you accrued a capital gain, but you reinvested the capital gain, the law actually, the Capital Gain Tax Act actually provides that the supposed capital gain capital gain tax will not be deemed payable because you have reinvested it. It will only be deemed payable to the extent of the portion of the capital gain that have not been reinvested. That therefore means that in accounting estimate, you'll be expected to have paid the tax. In tax estimate, tax is giving you an exemption because you have reinvested that capital gain. That will definitely give rise to a temporary difference. And when you want to, and that temporary difference is also taxable because there is an impending tax, whether payable now or payable in future, right? So what we are now trying to say that if you want to make provision for the deferred tax that will accrue on that kind of transaction, you are not using 0% of a small company. You are not using 20% of a medium-sized company. You are not using 30% of a large company because the type of tax that accrue on that transaction is not liable to a company income tax. Rather, it is liable to capital gain tax. So the applicable tax rates that you will use in booking that future tax exposure is the CGT rate, which is 10%. So that was what I explained with regards to booking deferred tax provision on transactions, temporary difference, resulting into a future tax that is not liable to CIT, but a CGT. So I need you to confirm, Akonji, confirm whether you understand that, and Olawale also confirm whether you understand that. Olawale, confirm whether you understand my explanation on the deferred tax implication on CGT. My point is, in booking your deferred tax provision, okay, awesome. In booking your deferred tax provision, make sure that you are using the applicable rate. If the tax law has not proposed any rate, it means that even if there is a temporary difference, but that is taxable, but it is taxable at 0 rate, or it is taxable at 10% if it is CGT, or it is taxable at 20% if it is CIT of a medium-sized company, or taxable at 30% of the CIT of a large company. Then it is also important for us to note that deferred tax asset and deferred tax liability, even though it is a future tax, you know, it is the practice in financial reporting that when you have a future provision, we will always discount it. We talked about that in lease accounting, right? IFRS 16. But because this is deferred tax, your ₦1 tax deemed payable today is also the same ₦1 deemed payable tomorrow. IAS 12 frowns at discounting deferred tax asset provisions or deferred tax liability provisions. Okay, good. Okay, so still under the context of measurement of deferred tax. Remember, our topic is IAS 12 income tax with special attention to deferred tax provisions. And why we decide to pay attention to this is that we have observed that this is an area that most accountants or even auditor in practice often have certain challenges. At KCP, we've decided to just share some of our views on this topical issues to bridge the knowledge gap amongst professionals. I believe that this kind gesture is well appreciated. Measurement of deferred tax assets. IAS 12 provides the following guidance on measuring deferred tax. Where the tax rate or base is impacted by a manner in which the entity recovers its assets or a liability or settles its liability. Whether an asset is sold or used, the measurement of the deferred tax is consistent with the way in which an asset is recovered or liability is settled. That is part of what I've explained earlier on. When deferred tax arises from revalued non-depreciable assets, revalued land, deferred tax reflect the tax consequence of selling the asset. So when you have revaluations of assets, it will definitely have a tax consequence. Why is it so? Because the revaluations will have been recognized as an income in your accounting, right, in your financial reports. But as far as the tax is concerned, such income is not a taxable income until when that asset is disposed. So this will always give rise to deferred tax provisions this will always give rise to future tax exposure that needs to be booked today. Then the next one that the standard also emphasizes deferred tax arising from investment property measured at fair value under IAS 40. Investment property reflect the rebuttable presumptions that investment property will be recovered through sales, right? I think I've also used an illustration to buttress this earlier. If dividends are paid to shareholders and this causes income tax to be payable at a higher rate, higher or lower rate, the entity pays additional tax or receive a refund. Deferred tax are measured using the tax rate applicable to undistributed profit. I believe I also explained this when I mentioned section 19 as a way to book in your CIT provision. I'm trying to flip back for you to see where that was mentioned. I earlier states that CIT could be estimated in line with either section 40, which is the rate of tax, section 33, which is the minimum tax provision, section 30, which is the taxation computation of CIT on turnover basis, and section 19, which is a dividend basis, right? So if in any particular year, a company has paid as dividends an amount which is higher than its taxable profits, the tax authority will not accept this. They will result to subjecting that company to tax on dividend basis. And until when that is done, whoever that is making the provision for the deferred tax must account for the potential deferred tax exposure that could arise on that. Somebody asked a question here. On the revalued assets, what rates are we using to book the deferred tax, please. Okay, let me throw the question to the house. I've done a number of explanations on this before. Somebody asked a question, please listen, everyone. On the revalued assets, what tax rate are we using to book the deferred tax, please? I want to confirm if anyone has answer to that. If not, then I can now provide my opinion to that. Anyone? If you have answer to that, can you provide the rates? The first question, the first guidance you will have to use is that what kind of tax could likely accrue on this kind of gain? Is it a CIT? Is it a CGT? Good. Sheung confirms that it's a CGT. That is very correct, and I will buttress that with this example or explanation. Whenever you revalue an asset, tax authority or our tax law does not recognize revaluation gain, right? Therefore, it is only the original cost that you have incurred on that asset that is recognized within the purview of our tax law, right? And that cost of that asset is recovered through capital allowance that has impact on our CIT. Do you understand? So when a revalue asset is now eventually sold, the potential tax exposure that could accrue is CGT. When you make disposal of a capital item, the tax exposure, the potential tax exposure that will accrue on that is CGT. So thank you, Sheung, for providing Olawale with that explanation. Thank you. It shows that everyone is following. Bravo. All right, so that is where, because of time, that is where we're going to call it a day today. In our next section, next episode of this, we will be looking at a practical approach, how you actually do the deferred tax computation. We will look at also how you do your company income tax computation, which is the current tax provisions, and we'll also look at these deferred tax provisions. But please, I need you to ask questions. Ask your questions now within the next 10 minutes on areas you want me to further buttress on, or areas you don't understand, or practical scenarios or encounters you've had in the place of your work that you want us to rub mind on. Please ask your question. Any question? Any question? While we are awaiting this question, I need to emphasize again that this training section is actually anchored by KCP. KCP is a professional accounting firm. We render tax services, we render accounting services, external audit services, investigations, and training. It is the training portion or bucket of our services that you all are enjoying now. Do not hesitate to reach out to us should you have any question or issues practically or on the field, or in respect of your client or your employer with regards to various scope of service. Somebody asked a question here. Which deferred tax is positive and which one is negative? Which deferred tax is positive and which one is negative? Abolale, thank you very much. She has answered, is it he or she? Has answered that question. Deferred tax asset is negative because it is an income. And the accounting entries I earlier said, you will debit a deferred tax asset and you will credit the tax expense. By so doing, it will appear as a positive figure. It will appear as a positive figure, but it is an income. You know, income ordinarily will always be a positive figure, but in your computation, you will see it in a jacket. Whenever you are computing deferred tax and you see it in a jacket, It means it's an asset and it should be debited in the deferred tax asset and credited on the expense. So if you credit anything on the expense, it's telling you it's an income, while the other one is a positive, that is a liability. To recognize that, credit your deferred tax liability and debit your deferred tax, your tax expense, I meant to say. Okay, Lanre says, please, is the application of deferred tax provision optional for a limited liability company? A capital letter no, it is not optional. The standard IAS 12 actually emphasized that provided you are in a business and you have potential tax exposure in the country where you are operating from, that company should pay tax. At what rates? So you will only have the option of not recognizing it if the company don't have tax exposure based on the prevailing law in the country where you're operating. So technically, except as contained in the recent amendment to our tax law, that limited liability company doing turnover of less than 25 million may not do deferred tax provisions. Somebody else says that on the sales of assets with gain on disposal, but the proceeds, cat sum, was used to procure a similar asset, will the transaction be liable to CGT? Okay, I've also explained that whenever you dispose an asset and you have a chargeable gain, CGT will only accrue if you have a chargeable gain. Let's do a practical illustration of that. You acquire a motor vehicle, you acquire, let's say, an office equipment, right? That's, let's say, an AC for 100,000, and you dispose it for 120,000. In recognizing your CGT, you must not reckon with the depreciation that have been done in accounting or capital allowance that have been done in tax. You will simply look at what is the cost of the asset, 100,000. What is the proceeds on the disposal, 120,000. If there is no cost to selling it, your chargeable gain is 20,000. If you now use that 120,000, which of course includes the gain, to buy another AC and use it for that business, that company within the purview of our CGT will not pay CGT. But we know that that is an embedded, there is a future tax consequence on that transaction, right? Whether that now or later, that tax will crystallize. So we need to book the deferred tax consequence. I believe that answers your question. Olawale says, if it is certain that companies cannot recover the deferred tax assets in future, do we derecognize the deferred tax? Technically, no. What the standard only provides is that stop accruing that future tax, future deferred tax. Stop accruing it when it is not visible that a company, or probable that the company will be able to recoup all its deferred tax asset already provided. Just stop to booking it until when the situation returns to normal, when you can continue either booking it or whether subsequent transaction will even lead to its future recovery. I want to believe that answers your question. If not, please reaffirm. What are the subsequent recognition of deferred tax? Good. Subsequent recognition of deferred tax, there will be movement on this deferred tax. Let's say, for example, in year one, please permit me to use my bird. Let's assume that we want to make an illustration. In year 2010, you actually have a deferred tax asset of Please confirm if you can see my screen. Can you see my board? You can see my writing on the board. Confirm if you can see that. Okay, so in year 2010, a company have a deferred tax asset of say 20 million naira. Remember, the accounting entry will have been debit deferred tax assets and credit tax expense in the income statement, right? If in year 2, which is 2011, the deferred tax asset, they also have a deferred tax asset, but this time it is no longer 20 million, but 15 million, right? What that means is that there is technically a deferred tax liability there. And how you are to pass the entry, you will pass the entry of the moving balance. What is the moving balance here? It is 5 million. So what you will then need to do, the book balance of your deferred tax asset has reduced from 20 million to 15 million. What you will then need to do to pass the entry is to debit your tax expense, which is your income statement, and credit your DTA. Even though what you have in the second year was still deferred tax asset, but it has reduced, meaning that there is an element of recovery there, right? So that is how you recognize it subsequently. Sometimes it can even go as far as say you are having, in the first year, you are having 20 million a DTA, but in the second year, you are having a 35 million. Remember, DTA will be in a jacket. You now have a positive figure, which is now a DTL, right? First year, you have a carry forward balance of a deferred tax asset of 20 million. How would you recognize it? Earlier on, you will have recognized DTA as a debit and the credit in the tax expense, right? But in recognizing this subsequent entry, what you need to do is to recognize the movement. What is the movement here? You have a negative 20 million. What can you recognize between the two to make it have a positive DTL? The movement here is 55 million. 55 million. So what you need to do is to debit your DTA ledger with 55, credit your DTA ledger. Sorry, 1 minute, please. I want to use my eraser. So credit your DTA ledger with the 55 million and debit your tax expense with 55 million. Remember, if you were using the ledger, your balance BD from here before was 20 million. Here, it is now 55 million. Your carry forward balance will then be 35 million, which now show you that you are having a deferred tax liability of 35 million. So that is how you recognize, movement of deferred tax year in, year out. Please ask questions, more questions, if you still have any, or clarifications on the areas you don't understand. All right. Should I assume everybody understood what we have taken thus far? If you understand what we have explained thus far, say yes. Or say hi. Let me differentiate it from previous correspondence. If you understood what we have explained today thus far, say hi. Okay, Abasade, thank you. Larry, thank you. Lawale, thank you. Sharif, thank you. Akonji, thank you. All right, so we sincerely want to appreciate you for your time. We hope to having a continuation of this. We will try as much as possible to communicate with you, but please, for you to get a further update on when our next training will be, make sure you try as much as possible to follow us on our various social media handles. You can see it on the screen. You have our LinkedIn page, Kunle Cole and Partners. You have our Twitter page at Cole KCP, our Facebook page at kcp.ng, then the Instagram, kcp-ng. Please, I will so much love to have more feedback on you, and we look forward to having you following us on our various social media. Please do not hesitate to reach out to us if you have any question, either on the areas that we have handled or on any areas in accounting, on any areas in the standard, or any topical issues on tax matters. Our office address is also displayed on the board, number 12, Lanre Awolokun Street, NCI bus stop, that is after Charlie Boy, Bagada Phase 2, and that is also our website. You can personally reach out to me on, if you have any question or you have a need for our service, you can personally reach out to me on 090-244-00652. 090-244-00652, or send me personal mail on Cole, A for Apple, C for Coke, O for Orange, L for Limca, and E for Elephant. acole@kcp.com.ng. We look forward to having your feedback. We look forward to having your questions and possibly future engagements with you. But we also encourage you not to limit this knowledge to yourself. Whenever you have publicity, try as much as possible to also share it with your colleagues that may be in need of this knowledge. We have this section recorded. We will be sharing it on our various social media handles, such that you can listen to it over and over and over again. Once again, my phone number is for Blessing and any other person who have not gotten it before. My phone number is 090-244-00652. We will appreciate if you also recommend us to your companies or recommend us to other potential clients that may need our service. Thank you very much, and enjoy the rest of the night. And have a very pleasant weekend ahead. Thank you. Good night.